Thank you, everybody. Now, unfortunately, Michelle and Mark also are having flight issues, so they can't be here with us today. But like last time, the show will go on, and we're going to continue as five speakers. So I'm going to pass over now to Sushila Nayak, who's going to get us started. Thank you.
Hello. Hello?
Yes.
Okay. Hi, everyone. Welcome to our panel. We are going to talk about private credit and the middle market. I'll start off just by introducing myself and then ask everybody on the panel to do the same, and then we'll kick it off. I'm Sushila Nayak. I'm a partner in the finance team at Orrick, Harrington & Sutcliffe, based in London.
I am Gabriele Gramazio. I'm the lead structured credit analyst for KPRA Europe. KPRA is a rating agency that has been active in the private credit space. We have assigned rating to business development companies, to middle market CLOs, especially in the US, and to other form of direct lending facilities, both in Europe and in the US. Hi.
Thank you, Gabriele. Good afternoon, everyone. I'm Paolo Morrone. I'm head of the UK direct lending team at TKO. TKO is a 45 billion AUM manager, of which private credit represents the bigger leg, and I'm responsible for effectively originating, monitoring the investments in the UK market.
Hi, everyone. I'm Robert Warchow. I'm a managing director and portfolio manager for the mid-market debt strategy at Pemberton. Pemberton is a 20 billion euro private credit specialist based in London. And the mid-market strategy represents about 60% of our overall direct lending AUM.
Hi, I'm José Ignacio Dengra, partner at Tres Mares, London-based, although I started in Tres Mares in the Madrid office. Tres Mares is a private capital platform backed by mostly by Banco Santander. Currently, we have 3 billion of assets under management, of which the vast majority is direct lending.
Thank you. So just to start with, we'll set out the landscape a little bit. The European private credit market has grown exponentially over the last few years, and there's been a significant increase in the number of direct and non-bank lenders in the market. So let's start by talking about, first of all, how that's impacted market dynamics and sort of the evolution over the last 18 to 24 months of this market.
Kicks off.
Do you want to start?
Yeah, absolutely. So what we have observed after the GFC is a process where, because of the evolution of the regulation, especially on the bank side, the banks, which are still and remain the most common provider of loan facility to the corporates, to retrench from the sector, to have restriction on their balance sheet, in particular with certain obligors. And this has left space for new actor to come into the sector and to trying to target certain obligor, especially in certain cases the SME, the smaller one, and they've done so successfully. So you have like the presence of certain asset manager in different jurisdiction that have successfully set up direct lending vehicles to finance essentially these obligors that in previous time would have gone through the bank lending essentially. And this process is well established and is continuing.
Yeah, and maybe if I can tag, I mean, certainly we see the asset class as something very established. I mean, I think most of the firms sitting here have been operating in the market for more than 10 years, so effectively it's not necessarily something extremely new, so it's very well tried and tested. So on our side, we're investing vintage 6, so it's been certainly a long journey. As Gabriele said, things have been changing and evolving. And I think it's fair to say also in the last sort of 18 or so months after, so we regularly see mini cycles within our investment horizon. So in the last 18 months, certainly things have been continuing to be, volumes have been continuing to grow on the fundraising side, but also on the investment side, the asset class become more and more established. When the BSL market effectively shut couple of years back, we've been effectively also tapping into the larger cap space to effectively provide liquidity to the transactions that were meant to be covered by the broadly syndicated market. So again, giving an extra step to the story of the private credit side. So I'm certainly there's been a lot of changes in this last 18 months. So in terms of broadening the scope of the investment of the investor space, new players coming into the market, and then maybe we'll touch on it later in terms of what it implied in terms of structures, competition. But I don't know if you have different views on the evolution.
No, I share a lot of those same views, and I think the macro conditions over the last 18 months have just accelerated the trends that were already there and all the things that both Gabriele and Paolo have touched on. I think, and you've probably heard some of the other panelists today talk about this, but the market isn't really just one homogeneous market. It's really sort of segmented into different pieces. And so, a lot of the dynamics that Gabriele talked about in terms of the bank capital restrictions, moving volumes out of the banking market into the private market, have been sort of multi-year things that have been moving volumes towards us in the core sort of middle market. Some of the dynamics that Paolo touched on have really accelerated volumes coming into private credit out of the syndicated market as well. So we're sort of seeing growth across all the different market segments. And I think that comes back to a few different things that we can provide as direct lenders and as private credit providers. Is we can provide a lot of transaction certainty to borrowers, particularly private equity. And I think with the market volatility over the last 4 years, if you rewind all the way back to COVID, I think that the ability to deliver that transaction certainty adds quite a lot of value to anyone involved in an M&A process. And so I would add that to the dynamics that the other panelists have talked about.
Yeah, I would like to comment on this point. The transaction certainty is something key, but also the flexibility in the execution. And once you are there invested in the transaction, usually the business model from the direct lenders is to continue supporting the growth story, which is particularly important in build-up strategy from PEs. Usually, especially in the lower mid-market, banks are struggling once they achieve their maximum ticket. I would say direct lenders have much more flexibility and swiftness of execution in those situations.
And actually, let's drill down a little bit on what Robert had mentioned in terms of structural differences and market segments and different types of private credit products for different segments. And we can talk maybe about some of the legal constructs and lender protections in different products for different segments, but also perhaps the way that banks and private credit interact or can be compared in terms of middle market, large cap, and then within those middle market area umbrella, how the segments are different from each other. We can maybe expand on that.
You want me to start?
Yeah, go ahead.
Okay. Well, I would say banks and funds can live different situations depending on the transaction. We can be just pure competitors in funding one transaction, and sometimes PEs or even corporates are analyzing both alternatives. But on the other hand, sometimes we can collaborate, and it depends also on the market. In some markets, it's more common to see banks and direct lending funds to collaborate. For example, Spain is a market where we have closed transactions where banks are taking the TLA, funds are taking the TLB. Also in the UK, we are seeing alternative structures like FOLO, where the banks are taking the super senior while we are taking like the first loss piece of paper. Obviously, banks should be there in most of the deals, like providing ancillary facilities, RCF, stuff like this. But also, I would extend the collaboration. As I said, for example, some banks are being the core LPs in some funds. So, I mean, I think banks and direct lenders should stay in the long term. Each player will take his role in the market.
Agree with that as well. I mean, I think, again, some of the structural questions, again, come down a bit to which segment of the market you're talking about. Clearly, if you're looking to complement or provide a substitute to more of a syndicated market transaction, you'll need to be able to provide documentation that a borrower would get in that market in order to effectively compete. And so what you're seeing a lot at the sort of larger cap end of the market are structures that look a lot like syndicated market structures with cov-lite structures and other protections that mirror more the syndicated market. Our view is around the sort of core mid-market, so businesses that don't normally have access to the syndicated market. For us, that really means kind of 15 to 75 million of EBITDA. It's a less liquid product, and you need the documentation to reflect that. And so I think what you'll find, certainly as we look at our mid-market strategy, is that we're really focused on having a lot of those covenant protections, but really, almost more importantly, restrictions around raising incremental debt or paying dividends or other types of value leakage, because we're really most of the time the sole or lead lender to these companies. There's not a secondary market that we can trade positions into. We have to manage it, and so we need those controls in place. And so, I would highlight that as another difference between the different parts of the market as well.
Yeah, totally agree that it really changes on where you're playing. So sometimes, as Juan said, you end up competing with a bank for maybe two different structures. So a sponsor might be looking either at putting a unitranche or a senior bank club. If you look at the smaller, let's say, small end of the mid-market, sometimes actually you need the bank to do the super senior RCF, and maybe they want to take a tranche of your TLB in order to be on the term loan as well. So it's really an ever-evolving process, and I think having been part of this market for almost a decade, we could definitely see the evolution of these trends across jurisdiction as well. So I think most markets tend to have their own special dynamics. So probably in Spain, the prevalence of banks into the LBO structures, at least on the mid-market, which is something we also play in. So we tend to focus between 10 and 40 million of EBITDA. And so that results into structures that start at 50 of debt up to 200. And so maybe in Spain is a market where we see more banks doing the actual club. In the UK, perhaps due to the variety of alternatives funds can offer, the banks tend to be less active on this angle of the market. But for instance, Italy and Germany, it's been a mixed bag. France is not too dissimilar from Spain, but the market is way bigger in terms of actual depth of the PE market. So it depends also on jurisdiction and depends on across the cycle really. So from our side, we've seen banks pulling out, for instance, from the large cap market when the BSL closed, and that impacted also the way funds adapted to their investment proposition. So perhaps moving upwards into larger deals in order to be able to effectively cover the hole left by the banks and the liquid market. So I think overall, the way we see this and the way we would like to explain this to our investors, that effectively funds and banks to create a more solid and more liquid market and give effectively more alternatives to borrowers.
Yeah, and maybe to conclude on this, also on what Paolo just said, it's very important because very often, especially in the CLO world, maybe to catch some highlight in the reports on the news, they always say that there is a competition between the large banks in the syndicated market and the private credit. In reality, is in some cases the two complete each other, and it's very important that there are different dynamics in the lending space, and it's very important, like for instance, period of dislocation is the private credit market that can step in and essentially offer financing of obligors that are in distress situation maybe, or they are a more, how can I say, a more difficult situation to refinance that debt. This is very important, and it's also beneficial for the very same BSL market because it could potentially even reduce the risk of refinancing for certain company, thus reducing even the risk of defaults. So this has been a paradigmatic shift but all in all, in aggregate level, and I think it's quite positive. And also, we say how the private credit could be attractive for the lenders, could be attractive for the obligors, because effectively it gives options, but also for the investors, because effectively you get a better risk-adjusted return. Obviously, the spreads on these loans are higher compared to the one of the syndicated market. So all in all, I think it's a win-win situation.
Yeah, I think maybe just to put in context that point around risk-adjusted returns, certainly if you look at our current portfolio, we're running at about 300 basis points plus of sort of excess yield for a given single B credit relative to the syndicated market. So now we operate in a different part of the market versus the syndicated market. I mentioned we're more sort of mid-market focused, but we are able to compare ratings. And so, I think the relative value that you can pick up, certainly from our perspective, is quite attractive.
Yeah. And just to complement on this, it's interesting the fact that we are 3 direct lenders here, and each of us is focusing on a different part of the market. Now, you can compete in part of your upper scale of your deals with the BSL transactions. So your bank competition is quite different from my bank competition, meaning companies below 20 million of EBITDA that directly do not have access to the BSL alternative or the bond market. So when we are talking the comparison between funds and banks, it's a slightly different conversation in the upper mid-market rather than in the lower mid-market, where we are competing with high street banks, which is a much less sophisticated product. So I would say, depending on where you are making the comparison, the alternatives and the difference can be higher. The same with the documentation. It's not the same documentation and the protections we can establish in the lower mid-market than the one that can be seen in the higher mid-market. For which reasons the companies are riskier, are smaller in a market, for the lenders the scale matters. So I think it's interesting. It's an interesting conversation.
Thank you. And just expanding on that a little bit, let's talk about some of the trends that people are seeing in terms of structures in the direct lending market, and whether that is, in large cap or traditional middle market or lower middle market. But then also, if anybody has any thoughts on how this might compare to some of the trends you're seeing or that are being seen in the U.S. market, and some of the structures that have become more prevalent in recent times.
Yeah, look, I think obviously now we're talking about the underlying, we're talking about pools, but we need to think about distribution. So distribution can occur to the investors being LPs in different funds, but obviously the securitization, it's a very important vehicle that has established itself in the States as one of the main funding tool for the middle market sector. Now, last year, just to tell you 2023 was a record year. Issuance, I'm reading the number, sorry, it's my 5th day of the conference, so I need to read. It's about, 25 billion. The previous watermark was 22 billion in 2021. So it's an asset class that is establishing itself. It's already established. It's almost as big as the BSL CLO market in Europe. Is continuously growing. The performance is strong. You have some specialized lender that has entered in the sector that continuously market that and successful market that transaction. In terms of performance, the performance has been remarkably stable. And in terms of the notes that are issued out of this securitization, they drive about 100 bips of spread surplus versus, the BSL casing, essentially. And one of the trends that we are seeing, obviously, the US market, it's a lot bigger. The obligors themselves, they tend to have higher EBITDA. So I would say that the sweet spot for the middle market CLO in the US is between 20 and 50 million of EBITDA. In Europe, there are not many companies with such characteristics. But what we are seeing also in the US, more innovation coming on the front of the underlying. So we start to see the recurring revenue loans. So recurring revenue loans, these are loans advanced to companies that typically rely on the subscription business, where companies that are in their growth period, where sometimes the EBITDA is very small, sometimes even negative, and they reinvest their cash flow in their business. And essentially the underwriting that is done on this company is quite different from the usual EBITDA metrics, because obviously in this case the EBITDA it's a very small or negative number, but it's rather done on the size of the recurring revenue, on the subscription. What we have noticed is that this subscription, even in difficult periods, they tend to stick, so to remain quite reliable. And obviously the perspective of these obligors is that after 3 years, the EBITDA would be a higher number, a positive number, and you would switch to a more traditional way of lending. So we have seen this addition of this kind of assets, and obviously we have been very comfortable to assign ratings for credit estimates for such obligors. These ratings they tend to be lower, so I would say between B- and CCC+. That reflects the fact that obviously you have a negative EBITDA, so these obviously are young companies that are in the growth space, and possibly also slightly lower recovery. But this, I think it was an interest development coming from the US.
For sure, it's something that I think we've been discussing this, and is an area that has been explored in Europe as well for what concerns recurring revenue lending. Something, frankly, TKO we haven't ventured into, as so far at least, as we think that the pool of candidate companies is not necessarily broad enough. On the other side, I think the premium paid to effectively lend to a company that for the first couple of years effectively burns cash and you're paying your interest through your direct principal is not necessarily something the current premium in the market really justifies the risk. So I think in terms of actual trends, what we've seen more than venturing into ARR lending has been probably more the fact that the market has been effectively broadening with the ability to tap into larger businesses. On the other end, there have been banks as well that have entered the market through their own private credit funds. So on one end, increasing the competitive tension on some processes, which is not always welcome, but equally telling really that the market is ultra institutionalized. It offers, I think, a good enough track record that banks have now decided that it's the time for them not to lose out the opportunity. So our focus will remain still, despite the market has opened up and you have these larger players that try and focus into larger deals, which are potentially attractive from a volume perspective, but there are the terms of the broadly syndicated loan market that are creeping up a bit into that kind of documentation, for instance, into the pricing of the private loans as well. So we feel that in the mid-market space, and we have the impression looking at the stats of the latest underwriting that realistically the original underwriting terms have been remaining fairly consistent in the mid-market space. It's an angle of the market where, irrespective of the cyclical trends, there is always an element of origination that is required. So deeper teams, meaning feet on the ground most times. So having local teams originating a transaction in the local market where you invest, but also building the relationship not just with your clients or your sponsors, but equally with the advisors, with the lawyers, with the whole community that give you sort of an edge sometimes in the origination. So irrespective of the entry of new players, the new trends coming up from the higher mid-market into the space, we think that the mid-market, the pure mid-market remains highly attractive because it has very high barriers to entry, and the most established players would be able to leverage on those in getting a premium, which not too different from the one Rob was mentioning in terms of spread, or could be the illiquidity premium, but certainly there's also an extra related to the ability to underwrite, originate the deal, which not everyone can do.
No, I completely agree, and we share the same view in terms of if you want to really succeed in the mid-market space, you need to be local. You need to have a local presence for origination. but also just for monitoring and managing investments during the life of the investment. And I think of the question around structures both from a deployment standpoint, but also from a fundraising standpoint. And I think the jurisdictional differences in Europe really sort of feed into both sides of that, and also feed into the differences between Europe and the U.S. So clearly, on the deployment side, the structures need to be such that they can reflect the local market dynamics. So, for example, in Europe we see a lot less second lien. The second lien market's effectively non-existent in Europe for most parts, and so 99+% of the lending that we do is first lien senior secured, versus the U.S. market where you tend to have more of a second lien presence. The other key difference, certainly from our perspective, around deployment structures is we tend to be the first or the sole lead lender in most of the transactions that we do versus a U.S. market, which can be much more sort of club focused. And so again, that gets down to our ability and our desire to want to control voting and to really be able to navigate some of these local market dynamics that we come up against. So from my perspective, it's actually not a shortage of opportunities. I think there's plenty of businesses in Europe that have 20 to 50 million of EBITDA. I think it's more when the difference in Europe being that you just have these local jurisdictions that you need to navigate, whether it's from a legal perspective or a currency perspective, and you don't have that in the U.S. And so you've been able to see this BSL market develop a lot more in the U.S. because it's more of a uniform market across the entire country. But I do think on the structurals, on the investment and fundraising side, we are seeing some really interesting structural developments. You can do private market CLOs. We've done one, but it takes a lot of very bespoke structuring and negotiation. Certainly at the moment, and so it's hard to see that becoming a really standardized product like you've seen in the U.S. But one thing I think that is exciting that we're also pursuing is the wealth channel through some of the LTIF structures that are available, and there is significant demand. I think similar to what you've seen in the U.S., there is significant demand for that in Europe as well, and so I think you'll see that become more prevalent from a fundraising perspective.
Yeah. Following on what you said of being a sole lender, or at least the main lender, is something that I think that still is very valuable. And I combine this with the structuring of the transactions. I think that as you said, the second lien structure is something that we don't see in Europe. But I would say also the classical structuring of senior provided by banks or by one lender and the METs or pure subordinated piece is something that is also disappearing. At least in my case, I don't see it quite often anymore. And that means that both lenders and also borrowers prefer to have a simplified transaction. We commented also before, execution, speed of execution, certainty is something that people is valuing. And at the moment that you have more than two lenders in the negotiation, everything is slower and everything is more complicated. So I would say direct lending funds are filling that gap. Being the sole lender is something that also is valuable for the investor of the fund because it provides you with a better negotiation power if something happens, or not something wrong, but for example, if you need to amend the SFA to extend the facilities or to amend whatever clause is something which is smoother and faster. So also is combined with the fact that direct lenders are growing in scale. So at the very beginning of the market, I don't know exactly the figures, but it was, especially in the local markets, it was not so common to find a direct lender that can provide 200 million for one single loan. Now is 200 million, I would say, is something that is relatively common, or indeed potentially in the low end for the big guys. So, the fact that borrowers and also lenders want to be the only provider, speed of execution and scale is accelerating the disappearance of combined structures of first lien, second lien, senior and METs, or even follows. And that's why I think direct lending is getting more and more important in the market.
I don't know if you agree with that. I think what we observe is the increased requirement for capex and acquisition facilities as well as a key driver of this, because clearly adding new debt later on requires more people to sit at the table if you have a first lien, second lien structure, while most sponsor strategies, especially in Europe, which is a market historically dominated by small-scale businesses, obviously the key play for sponsor is to effectively aggregate, create local champions, European champions, do growth through M&A. I think the ability for direct lenders to have the scale to effectively support this through new debt has on one end favored the direct lending taking share of the banking market, and on the other side also differentiates a bit between direct lenders for those who actually can do that journey and those who cannot, and it's obviously a very good origination route, for instance, so to be able to effectively follow the business going forward.
Yeah, I agree with that, and it's important from our perspective as well. And I think it feeds into what we think is another really important feature of the European market, which is that the market is at a much earlier stage of consolidation versus, say, the U.S. And so, one dynamic in our portfolio that we've seen in the last sort of 12 or 18 months is that our leverage levels have actually come down, our opening leverage levels, because of higher cost of capital. And we're cash flow lenders, and so if you have higher cost of capital, leverage sort of has to come down in order to keep the same cash flow coverage. But enterprise value multiples have stayed the same, if not increased slightly. And so, private equity is putting more equity into these structures as a percentage than they were 3 or 4 years ago. And the question is that we often get is, why is that? Why does that make sense for the equity to put more money in when cost of capital is higher? And I think it comes down to the market dynamics, right? There's more opportunity for M&A. We and others can provide that M&A financing over time, and the value that can be created through increasing scale, taking costs out of a business, professionalizing the operations, and standardizing things across countries really is a value lever that's available, I think, for sponsors in Europe that isn't as available for sponsors in the U.S., where that market is just much more developed.
Yeah, on the money side, I would say this is a classical conversation you have when your counterpart is not a very professional financial sponsor and rather is a corporate. We need to explain the benefit of that multiple arbitrage you will benefit from is something that is worth to pay 300 bips more, as you were mentioning on your spread versus a bank financing. And I think direct lenders on those kind of situations is the clear winner. The flexibility, the capacity to support the business in the long term is something that other lenders cannot do.
Thank you. So following on to a couple of mentions of competition between banks and direct lenders in the large cap market, but also on preferences to be the sole lender, there have been some instances in which banks and direct lenders have actually been able to collaborate in this market. Let's talk about what has been done and how you see the opportunities developing going forward.
Should I start?
Sure. Go ahead.
So for sure, the main opportunity for banks and funds to collaborate have been obviously on the deal side. So it's pretty standard to still have funds not providing the RCF, for instance. I know some funds do it and they have dedicated pocket of money for that. Others do not. So one traditional play is to effectively still set an intercreditor for what concerns the RCF. On other sides, obviously there are still, although not prevalent as mentioned earlier, there are still senior and substructures sometimes hitting the market. So we can easily sit above a broadly syndicated structure or a club structure with an OCO piece as well, as part of either the pure direct lending or sometimes also the special credit strategy where you try and target even a higher return, so probably in the double digit on a spread basis. But then also there are, so looking this for what concerns the deal, but then obviously there are structures where we need to put NAV financing in place for our funds. So banks are always, despite obviously there's now a market developing for private credit into the NAV facilities, but if you can fund through banks, sometimes it's still, I would say, the cheaper and easier options. So I think, and then obviously you have now banks sometimes setting up their own credit fund themselves, where the easy way for them to start gaining market is to try and partner up and say, look guys, can we take, I don't know, a 10% stake into your loan, and then we help you with the RCF. So we've been seeing this kind of dynamics where the banks are trying and effectively taking the spot into this market in different spaces.
Yeah, I think other areas that we've seen it, we have a senior loan fund that really is trying to take the space that's being created by banks pulling out of that 2 to 3 times leverage pocket of the market. But what we are seeing, and similar to the comment earlier, is you might have banks that still want to stay in for, say, a term loan A, and then our senior loan fund can step in and provide a term loan B next to a bank. That'll be very market specific. Spain is a market where we tend to see that. And then I think on sort of the other end of the spectrum, clearly if you have market volatility like we've seen in the last 4 years, having those bank relationships can be quite a good sort of origination channel for any opportunistic credit strategies as well. And we certainly had that with our strategic credit fund, where when the syndicated market has closed and banks have been hung on deals, we've been able to sort of get in early and talk to syndicate desks around how we can help them de-risk. It's certainly not for free, but it's something that we can do. And so I think maintaining those relationships across all these different business lines can help both sides.
Yeah. It's more I mean, it's certainly competition, but it's definitely a big element of collaboration. I think we all speak quite regularly with our relationship banks for the various products they support us with. But I'm sure that Tres Mares has even a deeper kind of...
Yeah, Tres Mares I would say is the most extreme example. But I would say in general terms, banks will continue to have relationship with the companies. So they will provide products that we are not interested in providing. So why not having kind of partnerships or good relationship with banks that can, as you mentioned, help you in the origination process? I can think on the opportunistic scenarios where they are suffering on the credits, but also in companies where they have maxed out the ticket size, so they need someone to continue complementing that financing, but they don't want to exit from that business, so they can introduce you the opportunity. You can establish the bullet loan behind their amortizing debt. RCF plus TLB is the classical example where we are collaborating. But for example, in Tres Mares, it's also true that we are using part of our LP, who is Banco Santander. We are trying to use their commercial network in order to position ourselves in companies where at some points we'll jump into the capital markets scenario because they will start doing an M&A or because they will sell the business to a financial sponsors. If we can have that first relationship, we'll position ourselves in a much better position than other direct lenders.
So we'll next move on to the topic that is just sort of ubiquitous when you're talking about BSL loans, especially in the US, but lender-on-lender violence. And first of all, how that might arise in the European private credit market, and obviously only in facilities where there's more than one lender, but to what extent you think that's actually a tangible concern in this market, and whether you think there are protections that are going into deals now to avoid it in the future.
But I think certainly for us, it's one of the main reasons. It's certainly a big reason why we focus a lot on documentation, because I think even where we are the solar lead lender, you really have to sort of button up all the various loopholes that could allow another credit provider to come into the structure. And so, as I mentioned earlier, we're the solar lead lender. We want to maintain that for lots of different reasons. You heard about the voting control. That's an important thing, but also just the relationship with the company, and also just to protect ourselves, so that if there is a situation where the shareholder of the company is looking to bring in a credit provider in a super senior position or something like that, that we have the ability to say no to that if we think it's the wrong thing for our LPs. So I think it's probably more a feature of the larger cap end of the market, where, as I said before, in order to really compete there, you're having to provide documentation that is more similar to the syndicated loan market. We haven't seen it really creep down into the mid-market in any sort of material way yet.
I think an interesting development would be once we start seeing the trading, and there would be, by statistically, some issues also in some of the larger cap direct lender-led kind of structures, where there are a number of direct lenders that will have to sit into the potential restructuring, and not everyone will have the same voting rights. So I think that would be an interesting development to see in our market in the next probably 3, 4, 5 years, when all the larger kind of deals that didn't hit the broadly syndicated market because the window was closed, and then they went into the direct lending space, and you have maybe 1 or 2 leading direct lenders and others that would just sit as passengers to some extent, and to see what would be the kind of arrangement they would come with, and maybe it could just end up in the similar scenario that you have in the broadly syndicated space, when you have basically the leading lenders collaborating sometimes with the sponsor, trying to find an arrangement that fits them best, and then probably others being cramped down or sitting behind. So for us, this has been so far a reason not to venture too zealously into the larger cap space, because again, it's a bit untested, the kind of relationship and how those would result into difficult situations, which ultimately, we care about the return, but obviously we need to look first at the ways where we can mitigate losses potentially in our portfolio when we have some defaults as well. So I think that would be an interesting new set of unprecedented, to some extent, kind of conversation. Those that have been doing more of the large cap deals will have to face.
Nothing major to add. I would say the lower you are in the market piece, the more you have to protect yourself in the documentation. Especially even the most extreme point would be a sponsorless transaction in the lower mid market, where you are acting kind of the sponsor. So you don't want the counterparty to have a huge flexibility in a company which is still small, is facing the market risk. Obviously is more exposed to the volatility of the market, and at that point of time you don't want to have like a huge flexibility in the documentation, because if they have, you can be in a situation where in a good performing business in the operating side, you can have a problem because of a wrong capital structure.
Great, thank you. So moving over a little bit to origination and administration and maintenance of your products, are there any technological innovations that you've seen recently in this market?
I can tackle on this one, what we are trying to do. I think that technology is the trending topic on the space, but I think sometimes people want to hear that the artificial intelligence is going to come here and replace human work. We don't see this on this place, but I think that again, the more larger is the business that we are analyzing, the more information is available on the market. While if you are more focused on the smaller businesses, it's still very manual process to analyze the sector and the businesses. So what we are trying to do is implement we are trying to cluster the economy in different micro niches. So we are using kind of an algorithm to identify the best companies, clustering those in different micro sectors and trying to understand why those sectors are growing faster or slower than the economy. I think we have a strong angle here, given if we are investing in sectors where structurally are growing faster than the economy, it's pretty difficult to us to make a mistake. You are not relying only on the analysis of one specific company, but also you are sustained because of the sector trends. And I think that technology can help on the analysis process because it's faster than humans. But at the end, you will need the team made of investment professionals to analyze the specific opportunity.
Yeah, I would completely agree with that. I think technology can help you make more informed investment decisions. I think it can help you track and monitor things more efficiently. I think it can, certainly from a systems and portfolio management perspective, we're implementing a lot of different types of technology just to slice and dice the portfolio in different ways and run different scenarios and run different types of modeling and things like that. But at the end of the day, that is an output that comes to the portfolio manager or to someone else, and you have to take that information and make a judgment and make a decision around that. So, certainly that's how we see it. That's the way that we're sort of utilizing it and implementing technology.
Same here. A lot of analytics. We don't waste data for sure. We ask plenty of data to our portfolio companies, not always in the most standardized way. So the challenge is obviously to consolidate that and make it, let's say, comparing apples with apples, really. And I think that's an angle where technology is helping out a lot managers also to keep costs down, really, because again, you have to hire analysts otherwise as an alternative. So being able to actually automatically extract, consolidate those, and providing more analytics for LPs, investors that are consistently requiring more information, because again, the asset class is becoming more liquid to some extent, that offers more data points. So I think on the rating side, you have plenty of to say about it.
Yeah, no, absolutely. Look, one thing, sorry, changing on the topic, I've seen also that there are questions related to the securitization of direct lending, and maybe, really to close also today's topic. So there has been obstacle to the creation of middle market CLO in Europe because of what we have essentially discussed today. Different companies that target different size of obligors. So some specialize in more SME, some specialize in is slightly larger middle market. There is a specialization at the level of jurisdiction. There is the issue that one of the most important markets is essentially the UK, which is obviously a different currency, which is in GBP. All these factors make it difficult to get granular pool, enough diversification. Some of you guys are specialized in only certain industries, so you also have some constraint in certain industries. 40% of some of the lender, it's entirely GBP. So how do you make it work in terms of FX and hedging this exposure, especially if you want to issue your liabilities in euro? Now, interestingly, so we see the obstacle on the securitization side. Something new, something that we are working, a project that we are working, is still related to the middle market. There is interest in insurance company to invest in papers rated. And this is coming in the forms of feeder funds notes. And so this is a very interesting development. We didn't see it coming necessarily, but the way that the arranger is structuring the deal of these feeder funds is to look a lot like a CLO. So this is really an interesting change. So you're going to have feeder funds notes, and be aware, this is very different from a standard securitization because the investors in the notes, so let's say the insurance company that buys the mezzanine, doesn't have a direct recourse on the underlying assets. But what is securitized is effectively, it's the interest of the LP in the funds. And in this case, it's interesting because the interest of the LP in the fund is the manager itself. So they created OC test, borrowing-based test. They have created even a WRF test. So for the people that are not familiar with the nomenclature from the CLO, this is the weighted average rating factor. So a rating agency would assign a certain score, a certain rating for each individual asset in the underlying pool, and the manager, as is ramping up the funds, needs to include certain assets based on their credit quality. And if the credit quality deteriorates beyond a certain level, well, certain assets will fall from the borrowing base, which will activate certain mechanisms that will deleverage essentially the feeder notes. And I think this is probably the most interesting. This is funds financing. This is not securitization, meaning that you're going to remain exposed to the manager to make the right call, to make that discretionary payment, that timely payment, which in securitization you don't care because it's a periodic payment that coming from the cash flow of your underlying pool. But you see how the world of securitization and the world of funds are colliding. Still very different analysis. You need two different methodology to analyze the product. But because we are struggling with the middle market CLO, here we go. in funds, the insurance company are comfortable to invest as LP, but they also want to take an exposure in the form of debt, and this is coming in this way.
That's very interesting. Does anybody, we're just about out of time, have any final thoughts on middle market CLOs, especially as they could or couldn't develop in Europe?
No, I think we've touched on, the main sort of obstacles. I think the technology question is actually an interesting one as it relates to that, because to some extent, some of these barriers, like different currencies, come down to modeling scenarios and having the computing power to model different potential outcomes in terms of currency movements. And so I do wonder, as that becomes more available, or as the technology around that gets better, if it will allow that to happen in an easier way. But yeah, I mean, I think so far the market in Europe is just very different to the U.S. And so it's the reason why you haven't seen, multi-currency CLOs in Europe, as an example.
It's going to happen,
So,
probably, just because all managers, at least the most established ones, tend to now have deep enough portfolio they can sort of take the assets from. So it's a matter of probably the investor's appetite that is going to be probably sort of a reverse inquiry kind of process. And I think once the investor appetite will be there, I think manager would be keen to structure around it. At least that's been in our side, the approach.
Great. Well, thank you all very much.
Thank you.
Thanks for joining us.